Hello guys, yesterday we have begun with the first lesson about options. I explained what is an option and how can you save a lot of money when you are buying options, but there is risk also. In today we try just to see what is important for you when you are buying an option and what is this idea of intrinsic and extrinsic value of the contract. Okay, so I will just give you a very easy way to calculate this, to calculate the option worth and its time. Okay, let's go. Now, so as you can see, okay, we have the chain showing you here, just an example, okay, showing you here the calls. It means if you here the calls, if you think that the market will be going up, okay, up, let's say Twitter, you think that Twitter is going up, you buy a call. But if you think that Twitter is going down, you buy what we call a put. Okay, if you think that Twitter is going down, you buy a put. Now let's give you, for you, the first time you want to buy an option with Twitter, for example. Okay, let's say you think that Twitter today is $28.01 and you want to buy a call. You think that Twitter in a few days will go up in order to make money. Okay, so what is important for you? The first thing that you should look at is the contract price, which is the ask here. All this ask here, this is what is important for you to look at. And you should choose which contract you want to buy, because there are a lot of contracts, as you can see. Each contract that you want to buy has a strike price. It means from where do you want to begin your strike. It means, is it 20, 25 or 26, 27, 27 and half and 28, or you go until 30. Now, the first thing, as I say, the contract price. So I take 3 examples and we try to explain them in general. Now we are taking this one, 335 with a strike 25. So this is the strike, okay, 25, and this is the contract price, $3.35. This is the price of the contract. Now, if you want to buy it, you should multiply by 100. So you are paying $335 for this strike. Now, what is the most important thing after that is this, the expiration date. And it says here, the expiration date, it's 18th of April. And what is left is 12 days. Now, what does it mean, this expiration date? Understand that if you leave your contract after 12 days and you don't sell it, it will be worthless. It means it should have no value at all. It will be 0. So you should, if you buy it, you should sell it before the expiration date. This is the most important thing. Okay, so we said 3 things. First, the contract price, which is this, the ask. Let's say you want to buy this one with this strike 25. Okay, now if you want to know what is the contract worth and what is the time value. It means when you are buying a contract, option contract, you are buying 2 things. One, you are buying the intrinsic value and you are buying the time to stay. It means this, April 18. Now, as you can understand, okay, in stocks you don't buy time, because you buy, for example, Twitter with this price, let's say $28.01. You can stay 1 year, 10 years, 20 years, no problem with that. You shouldn't pay anything in stocks. But understand, in option, you should pay for the time to stay. That's why we have an expiration date. Okay? So you should pay. Now you ask yourself, why should I pay? Okay, because they ask you to pay in order to stay in this contract. Because options works with intrinsic and extrinsic value. Now, for you, for example, how do you calculate? For example, you find $3.35 is the contract price. How do you know the value of your contract, and how do you know the time in terms of money that you pay? I will give you the easiest way to do it. Okay, it's very easy. Always put, this is the stock price of Twitter, 28.01. If you want to know the intrinsic value, it means how much is the contract is worth, what you should do is 28.01 minus, okay, minus the strike price, 25, equal, you will find $3.01. Is that easy? Yes, it is easy. Okay. Now, you know that the contract price is $3.35. But the contract itself, it means how much it is worth, it is $3.01. Now, in order to stay these 12 days, to stay 12 days, you should pay 0.34. Now, how do you get this time value? How do you get it? It's very easy. What you should do, contract price minus the intrinsic value equals the extrinsic value. So if the contract price, which is this one here, all this contract price, it means the ask, it means where you buy the contract, all this, okay, $3.35 minus the intrinsic value, which is $3.01, equals 0.34. Now, in terms of money, this contract is 335. Just I will give you an example to how to calculate this. Very simple to calculate it. Okay, let's break it down here. Now, $335, this is how much you pay. How much you pay for the contract, instead of buying the stock at $2,801, which is the whole 100 shares. You are buying this 2,801 cent. You are just paying 335. Now, 335. You are paying $301 for the value, which is this, the value worth of the contract, plus you are paying $34. This is the $34 for the time to stay, and then it becomes 335. So is this easy? Yes, it is so easy to break down this. But understand that intrinsic value and extrinsic value you can calculate it with any price. Now, let's go now to calculate another strike option. Okay, let's for example, you want to buy at the money. Okay, at the money here. It means you are buying this one here. You are buying this strike 28 here, 28 strike, and you buy the contract with $1.18. This is $1.18, which is the price here. So this is at the money. It means the stock price is 28 and the strike is 28. It means you are at the money. You are not paying too much, and you are this is what does it mean? Okay, it means you begin from 28, so you pay less, which is $1.18 only. Now let's say you want to know what is the intrinsic value. As I told you before, what you should do, very simple, $28.01 minus 28, you will have only 0.01. So why you are paying only 0.01, which is you are paying only $1 for the value? What does it mean? It means that your contract has very little value, which is only $1. Okay? Now you ask yourself, why I am paying $1.18 if the contract worth is only $1? What's the problem? Is that the thing here, you are not buying in the money. It means you are not buying from $25. So from 25 to 28, it is $3.01. So you are paying all this. It means as if you are buying from the past. Okay? So you should pay for this that you go far away in the past, because now Twitter is not 25, it is 28. But you are able to buy it at 25. That's why you pay more for intrinsic value. Now, we say, in order to know the intrinsic value, $28.01 minus 28, which is the strike price. This is 20 price here, 28, the strike price. You will find that you pay only $1 or 0.01 for the intrinsic value. It means that your contract has really no value. Okay, it's only $1. Now, what is this $1.17 that I am paying right now? Now, $1.18 minus 0.01, you are paying $1.17 for what? For the time value. Okay? So the time value are not the same in what you call, when you are in the money, when you buy from lower prices, strikes, the time value is not the same as, because it's not the same. So $1.17, okay, this is $1.18, the contract price. This is the value of your contract. 117 is only the time value, time that you want to stay. They ask you to pay a lot, okay, to pay $117 just to stay this 12 days, because from today to the 18th. Okay, now this is called at the money. It means the price, it means the stock price is the same as the strike price. So $28 stock price and $28 is the strike, so they are the same. So you are paying more for the time value, but you pay little for the intrinsic value, which is the contract worth. Now let's go to the for example, you choose 30, which is 30 strike, the strike price at 30 here. You choose a price that it is far above the Twitter price. So it is in the future. You will never know if Twitter will go to 30 in the following days or following month. But you don't want to spend money. You want just to bet on $30 that Twitter will go and get it. So let's now calculate the intrinsic value and the extrinsic value. As I told you, it's very easy. How do we calculate the intrinsic value? How do you know? So what you should do, $28.01 minus 30. So since 28 is under 30, so you will have 0. So your contract value has 0 value. It means it has no value at all, because the stock now is $28.01. Okay, and you try to think that the stock will go to $30 in the future. You are just betting for something in the future that it might never happen. Maybe the stock now is 28, it goes to 27, 26, 20, 15, and this you lose everything. Now, since you pay 0, what is this $45 that they ask you to pay, which is 0.45, which is this here? Why they ask you to pay? Now they ask you to pay the extrinsic value, which means time, and they ask you, because it is far away, they ask you only to pay $45 or 0.45. It means it's the same as contract price is only the extrinsic value. It means you just pay for the time to stay. And as I told you, that in options you should pay to stay in the trade, because if expiration date is April 18. Now today is 9. Okay, 9 April today. Now if you go to 18 and you don't exercise, it means you don't sell it. This contract, which is 0.45, will be worthless. Okay. Now you ask me what to choose. Now here is the thing. It's about what is your strategy. Okay. It depends on what you want to choose. Now, if you are into options, you try to begin making bets whatever you like. Okay, but understand, if you are right, all these will change and becomes bigger money. But if you think that the stock is going up but it goes down, all these will be going down. Okay, and I will show you, okay, in the future with the same thing. I will show you, let's say these 1, 2, 3 strikes that we have done here. I will try to see how much they are worth after a few days, just to give you the feeling and how these options work. Okay, so thank you very much for watching. Try just to make this table that I have made in order to calculate the intrinsic and the extrinsic value of the contract. But in general, it's not that much important. Okay? What is important is how to choose the strike price. Okay? You should have a strategy to do so. Okay? And understand that the good thing in options is that if you don't worry about having big losses. Now, why? It's just because what you put, either you make money or you lose it all. Now, when you lose it all, you should understand to see your risk. Okay? Don't buy too many. Okay? Don't buy too many contracts. If you buy a lot and the market is against you, understand that the market will wipe out all your contracts and becomes worthless. Okay? But if your contracts works good in a few days, let's say 1 week or 2, you will see that you will make a lot of money from it. But understand that there is risk. All money that you put into Twitter contract options, okay, if you make money, if the trend is with you, you will be making money. I understand there are a lot of what we call a lot of strategies that you will see online, or you go to your broker and you find webinars, but understand that whatever you do, if you miss, don't play on the both sides like the other people do. They buy 2 contracts calls and they buy 1 contract put, and they think they can be smarter than the market. The market will crush anyone who tries to play with the direction. That's why I always tell you, to make money, you should be with the direction of the stock or of the index or whatever. Okay? So, in the future, I will be doing more videos on options just to explain very easily, step by step. Okay? There are a lot of things to learn, but don't try to overwhelm yourself with information and with calculation that you will never know how it is calculated. Understand that calculations are made essentially by Wall Street guys. And Wall Street guys, they always have an idea, is that if you are wrong, your money is gone. You should be right to make money. Okay? So that's it. So thank you very much. If you have questions, just ask, and thank you very much.